Okay, so you want to own a shopping mall. Buy the building, sign some retailers, watch the rent checks land every month. Simple business. Except here's the part nobody tells you before they buy the property. You're not really in the shopping business, and you're not even really in the real estate business. You're in the business of selling other companies access to a crowd you didn't build. And the moment that crowd stops showing up, the entire structure underneath you can come apart in about 18 months. Stick around, because the mechanics of who actually pays for a mall, why the store you'd assume matters most matters the least, and why the highest margin real estate in the entire building might be a strip of asphalt at the edge of the parking lot, are stranger than almost anyone thinks. And if you get any one of these mechanics wrong, it isn't a slow mistake. It's a $250 million one. Let's start with the tenant everyone assumes is the prize, the anchor. Macy's, Dillard's, Nordstrom. The department store the whole building seems to be arranged around, with its own entrance, its own parking, its own end of the concourse. If you were designing this business from scratch, you'd assume the anchor is your best customer, the one paying the most for the most space. Here's the twist. The anchor is usually your cheapest tenant per square foot by a wide margin. An anchor department store typically pays somewhere between $8 and $15 a square foot, locked in for 20 to 30 years. Meanwhile, the inline stores, the smaller shops lining the corridor between the anchors, are paying anywhere from $25 to $80 a square foot, sometimes more, with additional charges stacked on top. So a mall owner is renting maybe 40% of the building to the tenant paying the least, and the other 60% to tenants paying 3 to 5 times as much per foot. Why would any landlord accept that trade? Because the anchor was never the product. The anchor is the bait. It's the reason the parking lot fills up, the reason people drive 20 minutes past 3 strip malls to get here, the reason foot traffic exists at all. The landlord isn't renting square footage to the anchor. The landlord is renting a crowd and paying a below-market price to manufacture it because that crowd is what lets every inline tenant get charged a premium. The anchor doesn't pay the mall's bills. The anchor is the bait, and everyone else pays for it. And here's a wrinkle that makes the anchor relationship even stranger. In a lot of older malls, the anchor doesn't even lease its building from the mall owner. It owns it outright. Department stores like Macy's and JCPenney frequently own their own pad and their own store, having negotiated that ownership decades ago as the price of signing on in the first place. Which means the mall owner doesn't just undercharge the anchor on rent. In many cases, the mall owner doesn't control that piece of the property at all. The anchor can go dark, sit empty, and simply hold the land, and there is nothing contractual forcing them to sell it, renovate it, or even mow the lawn. You don't just own less of the mall than you think. In its most valuable corners, you might not own it at all. This is exactly why so many dying malls end up with a lit, functioning mall wrapped around a dark, boarded-up anchor box that nobody can force anyone to fix. The mall owner has every incentive to re-tenant it, and zero legal authority to make that happen. Before we go further, it's worth understanding why so many of these buildings exist in the first place, because the oversupply itself is part of the trap. By 2010, the United States had built out to roughly 20-plus square feet of retail space per person, several times higher than most European countries, which typically sit in the low single digits. That wasn't demand-driven. A huge amount of it was tax-driven. Developers could depreciate a new mall aggressively, book the paper losses against other income, and effectively get the government to subsidize a chunk of the construction cost regardless of whether the mall ever turned a real profit. So the country kept building malls years after the rational, purely commercial case for building more of them had already stopped making sense. Which means a huge share of the malls sitting empty today weren't killed by the internet. They were arguably never supposed to survive this long in the first place. They were built for a tax benefit, not for 100 years of foot traffic. Now here's where it gets genuinely interesting, because the rent you just heard isn't the real number either. That's only the floor. Most inline mall leases are structured with something called percentage rent, and it's the mechanism that turns a shopping mall from a landlord's business into something closer to a silent partnership in every store inside it. Here's how it works. A tenant signs a lease with a base rent. Say a boutique clothing store agrees to $180,000 a year. Bolted onto that base rent is a clause. Once the store's sales cross a certain threshold, called the break point, the landlord starts taking a cut of every additional dollar, usually somewhere between 5 and 8%. The break point itself is just the base rent divided by that percentage. So on $180,000 at 6%, the break point sits at $3 million in annual sales. Below $3 million, the store just pays its base rent, same as any lease. Above $3 million, the landlord takes 6 cents of every additional dollar the store makes. On top of the rent, it's already collecting. So if that boutique has a great year and does $4.5 million in sales, the landlord doesn't just collect the flat 180. They collect the 180 plus 6% of the $1.5 million above the break point, another $90,000, for a total of $270,000. The landlord never lifted a finger, didn't sell a single item, just own the box the sales happen inside of. You don't just collect rent. You collect a cut of every good month a tenant has, and none of the bad ones, because that's already written into the base. Push further into the building, past the inline shops, and you hit the section of the mall that looks the least important and is often quietly the most profitable per square foot: the food court. A kiosk or food stall rarely signs a 20-year lease. It signs something closer to a 1 to 3 year term, with almost no build-out cost on the landlord's side. The tenant brings the equipment, the landlord brings the plumbing hookup, and the seating everyone else already paid for. Because the term is short and the risk to the landlord is low, food and beverage tenants routinely get charged some of the highest percentage rent rates in the entire mall, frequently 8 to 10% of sales above a very low break point. A 12-foot kiosk selling smoothies can generate more rental yield per square foot than the department store 100 yards away, because the landlord built almost nothing for it and locked in almost none of the risk. Now walk all the way to the edge of the property, past the last row of parked cars, and you'll usually find a handful of freestanding buildings that don't look like they belong to the mall at all. A bank branch, a chic villa, a cell phone store on its own little island of concrete. Those are called pad sites, or out parcels, and square foot for square foot. They're frequently the most valuable land the mall owns. A pad site tenant isn't paying mall inline rent. They're paying $30 to $60 a square foot, sometimes more, on a tiny footprint, because they're buying visibility from the road, not access to the mall's foot traffic. The mall owner didn't have to build anything elaborate. Pour a slab, run utilities, and lease it to a business that will pay premium ground rent forever, because that corner is the only corner in town with that traffic count. On a pure dollar per square foot basis, a mall's edge is frequently worth more than its center. The part of the mall that looks like an afterthought in the parking lot is often quietly outperforming the department store the whole building was built around. Now let's talk about the cost side, because everything so far has been about how the mall extracts revenue. But a mall owner is also unusually protected from the expense of running the thing. Nearly every mall lease in America is structured as a triple net lease. The name sounds technical, but the mechanic is simple. The tenant pays rent, and then the tenant also pays their share of property taxes, insurance, and something called common area maintenance, CEM for short. That's the cost of running the parking lot, the lighting, the escalators, the security, the landscaping, the snow removal, the roof repairs on shared structures. All of it billed back to the tenants, prorated by how much square footage they occupy. CAM charges typically run an additional $5 to $20 a square foot on top of whatever base and percentage rent a tenant is already paying. Think about what that actually means. The mall owner runs a building that requires constant, expensive physical upkeep, and structures the leases so that upkeep is barely their expense at all. The landlord doesn't run the building. The tenants run the building for the landlord. So, quick pause, because if this is the kind of thing you find genuinely interesting, the way ordinary-looking businesses actually make their money underneath the version everyone assumes, that's the entire purpose of this channel. So subscribe, and I'll keep taking these apart one industry at a time. Anyway, here's the part that makes this whole machine fragile in a way most people never think about, because everything you just heard only works while the anchor stays open and while the building stays full. Because CM isn't just a cost that gets passed through, it's a cost that gets redistributed every time a store closes. When a tenant leaves, their share of the parking lot lighting bill, the security budget, the landscaping contract doesn't disappear. It gets reallocated across whoever's left, prorated by their square footage. So the remaining tenants in a half-empty mall aren't just suffering from less foot traffic. They're each absorbing a larger slice of the same fixed operating costs on shrinking sales, which makes their own numbers worse, which makes them more likely to be the next ones to leave. It's a mechanical, vicious cycle built directly into the lease structure, and it's one of the quiet reasons dying malls tend to die faster once they start dying at all. Layer the anchor risk on top of that, and you get the real trapdoor. Buried in almost every inline tenant's lease is something called a co-tenancy clause. It says, in effect, if the anchor closes, or if total mall occupancy drops below a threshold, usually somewhere around 70 to 80%, the smaller tenant gets to pay reduced rent or break their lease entirely without penalty. This is where the dead mall era really started, and it started with a single word: bankruptcy. When Sears began closing hundreds of stores, and then JCPenney followed, and eventually chains like Forever 21 and Bed Bath & Beyond went the same way, it wasn't just one storefront going dark. Every co-tenancy clause tied to that anchor activated at once. Rent reductions triggered across dozens of inline leases in the same building simultaneously because the contract said they would. A mall's income doesn't erode slowly when this happens. It falls off a cliff because the entire rent roll was built on the assumption that the anchor would always be there. And the moment it isn't, the landlord has legally obligated themselves to lower the price on everyone else. One tenant closing a store can trigger a legal chain reaction that guts the income of 100 others down the hall. Here's a strange side effect of all this that most people never think about. You almost certainly already own a piece of this business, whether you meant to or not. The vast majority of large American malls aren't owned by a single wealthy family anymore. They're owned by real estate investment trusts, publicly traded companies that exist specifically to hold property and pass the income straight through to shareholders. By law, a REIT has to distribute at least 90% of its taxable income to investors every year, which means mall rent doesn't just sit with the landlord. It flows out as dividends into pension funds, index funds, and ordinary retirement accounts. In 2025, grocery-anchored and mall retail transaction volume reached roughly $11 billion, up 42% year-over-year, with institutional buyers accounting for 27% of that volume, the highest institutional share in over a decade. The mom-and-pop mall owner is basically extinct. What's left is one of the most financialized corners of American real estate, engineered by institutions for institutions. So now you understand the mechanics. Here's the part that decides whether any of it actually works. Not every mall is playing the same game, and the gap between the winners and the losers in this industry is enormous. Scenario 1. Take Simon Property Group, the largest mall operator in the country. In 2025, Simon pulled in $7.02 billion in revenue. Base minimum rent across their malls and outlets sat at roughly $58 a square foot. Occupancy was 96.5%, and the retailers inside those malls were doing $733 in sales per square foot, trailing 12 months. That's not a struggling asset class. That's one of the highest performing real estate portfolios in the country, quietly compounding while the public narrative insists malls are dead. Scenario 2. Take a Class C mall, the industry's own term for the bottom tier, defined as malls where tenants generate less than $300 a square foot in sales. Those malls are running a vacancy rate of 13.3%, more than 50% higher than the national mall average. They're the malls losing their anchors first, triggering co-tenancy clauses first, feeding that CM death spiral first, and entering the death spiral first. The top tier of malls isn't struggling. It's the middle and the bottom quietly bleeding out, while the winners at the top get harder and harder to compete with. And this split shows up directly in how these buildings actually get bought and sold. When institutional investors price a healthy, well-anchored retail property, they're paying based on a capitalization rate, essentially how many years of income it takes to justify the purchase price. The strongest, best anchored centers in the country trade at cap rates in the mid 5% range. The weakest, most distressed ones need a cap rate well north of 7% before anyone will touch them, because the buyer is pricing in exactly the collapse risk we just walked through. Same asset class, same basic legal structure, priced two entirely different ways, because one version of this business is a compounding machine and the other is a countdown clock. Run the same $10 million of annual income through both cap rates, and the gap in what a buyer will pay for it is measured in tens of millions of dollars. The exact same rent roll, valued completely differently, purely on how likely the market thinks that income is to still exist in 5 years. If you want to see exactly where that countdown clock ends, look at Pittsburgh Mills outside Pittsburgh, Pennsylvania. Opened in 2005, built for $250 million, anchored by big box tenants that were already fading the year the mall opened. Within 2 decades, it was functionally empty. No serious demolition plan, no redevelopment deal, just an enormous concrete shell sitting on land that once justified a $250 million bet. And Pittsburgh Mills isn't an outlier. It's closer to the median outcome now. American malls peaked at roughly 2,500 enclosed properties in the mid-1990s. Today, depending on whose count you trust, somewhere between 700 and 1,100 are still standing. No new enclosed regional mall has broken ground in the United States since before 2020. When a mall does finally die, it doesn't die quickly. The average dead mall sits vacant for 3 years and 11 months before anyone does anything with the property. And when it finally sells, it sells for 43% below what the owner originally paid for it. In 2025 alone, 2.6 million square feet of dead mall space was physically demolished, bulldozed, not repurposed, because the building itself had become worth less than the land underneath it. The math always wins eventually. It just takes longer to lose than anyone building the thing ever expects. But here's the twist inside the twist, because dead doesn't always mean gone. Roughly 46% of mall redevelopments end up converting into mixed-use projects, apartments, offices, entertainment venues built into the old retail shell. Another third of vacant malls manage to claw back some retail tenants through pop-ups and short-term leases before any full redevelopment happens. The land underneath a dead mall is often still enormously valuable, sitting on a highway interchange zoned for dense development, already wired for utilities. So the mall itself can die completely as a retail business and still generate a second act as a residential or mixed-use asset, because in the end, the real thing that was ever valuable wasn't the building. It was always the dirt it was sitting on. Meanwhile, at the opposite end of the spectrum, the malls that never let themselves get anywhere near that cliff are pulling further and further ahead. Indoor malls, taken as a category, actually posted rising visit counts across every single quarter of last year. Not a rebound story, a genuine growth story concentrated almost entirely in the top-tier properties that kept reinvesting in dining, entertainment, and experience-driven tenants rather than coasting on department store leases signed decades ago. The gap between the best malls and the worst malls isn't closing. It's widening every single year, because the winners are compounding their advantage while the losers are compounding their decline. So if you're actually thinking about buying into this business, here are the 3 costs that quietly wreck first-time mall investors, the ones that never show up in the marketing deck. Mistake 1, underestimating co-tenancy exposure. Buying a mall anchored by a single struggling department store without pricing in what happens to every other lease in the building the day that anchor leaves. Mistake 2, underestimating the CM death spiral, assuming operating costs shrink with occupancy, when in reality they get redistributed on fewer and fewer paying tenants, accelerating the exact decline you were trying to avoid. Mistake 3, valuing the building instead of the land. Paying for the retail income today without pricing in what the dirt underneath is actually worth if the retail business fails, which is usually the only number that keeps a distressed mall from being a total loss. So here's the real reframe, the one that gets lost every time someone says malls are dying, like it's one simple story. A mall was never actually a retail business. It was a rent extraction machine wearing a retail costume. Engineered to underpay the tenant that creates the traffic, overcharge the tenants that benefit from it, quietly out-earn the whole operation from a food court kiosk or a strip of parking lot asphalt, offload almost every operating cost onto the people paying you rent, and take a percentage of anyone who happens to have a good year. When that machine is fed a strong enough crowd and financed by institutions who understand exactly what they're buying, it becomes one of the most efficient landlord businesses that exists. When the crowd stops coming, the same contracts that made it efficient are exactly what tears it apart, tenant by tenant, in a matter of months. The building was never the business. The traffic was the business. And the moment the traffic leaves, so does everyone who is only ever there to be near it. Now, if hidden margins built into ordinary-looking real estate is what you came here for, here's a strange one to sit with. Somewhere in that same mall parking lot, there's usually a business running a similar trick on a fraction of the footprint, and it's pulling a return per square foot that would make most mall landlords jealous. It's the automated car wash, a business most people drive past without a second thought, that in the right location is quietly running gross margins north of 80%, on a piece of land you could fit inside a single mall parking aisle. Next time, we're breaking down exactly how a business that small produces margins that large, and why the real money in that industry has almost nothing to do with washing cars.